Hi, so before starting the golden rules of accounting, let me quickly recap what we studied in the last lecture and let us solve an example for it. So we studied the categories of accounts, which is first is personal account. Personal account can be of three types, that is natural person, which is any name or it is related to natural person, which is quite obvious. The second one is artificial person, which means any club, any company or bank or any corporation. This is an artificial person which exists in the eyes of the law. And the third one is the representative personal account, which says that accounts such as wage outstanding account, prepaid insurance account, accrued interest account, and basically these accounts are collective groups of accounts for collective peoples, more than one people. Okay, now let's move on to real account. As you can see right here, it relates to assets and properties. So as you can see, it is tangible or it can be intangible. Tangible are plant, machinery, cash, furniture, etc. And intangible are goodwill, trademark, copyright, franchisee, patents, etc. And now let's see what nominal accounts are. Nominal accounts are accounts which are related to income, expense, losses, and gains. So, income and gains together, and expenses and losses. Some examples are wages, rent, interest, salary, or bad debts. Bad debts is a loss, hence it is a nominal account. Right here is our first illustration, which says how will you classify the following into personal, real, nominal accounts. So let's see if we can do it. The first one is investment right here. What are investment? Investment are assets, and assets relate to real account. Yes. What is a freehold premises? Freehold premises is our property, hence it is also an asset which is a real account. Accrued interest, as I explained you the three natures of the personal account, and the one that we didn't understand is the accrued interest, so it is a personal account. Punjab Agro Industry Corporation, hence it is a artificial person, it is a personal account. Janta Allied Mechanical Works, it is also an artificial person which is a personal account. Salary accounts, okay, so salary is our expense, hence expenses, losses, gains, and incomes are nominal account. So right, I want you to pause the video here and continue yourself on your own. Okay, so I hope you should have cracked it by now. If not, let's go together. This one says here loose tools account. Loose tools are our assets which we'll use in the business, hence it is a real account. Purchase account and sales account. As you can see right here, when we read the definition of a real account means whatever is related to the assets of the company. Hence, purchase and sales are related to the goods or services of the company. Hence, this is a real account, and this one is also a real account. Okay, Indian Bank Limited, bank is an artificial person, it's a personal account. Capital account is also a personal account. Brokerage account, brokerage is our expense, hence it is a nominal account. Toll tax is an expense, hence it's a nominal account. Dividend received is our income, nominal again. Royalty received or paid is expense or income depending on the question, hence it is a nominal account. So if it was tough for you, I recommend you open that sheet once again, the resource file, or you can check this resource file and you print it out or you take the notes of it, and then you compare these questions, these illustrations with the personal, real and nominal account and try to categorize them. Now let's check out the most important concept of our accounting, which is golden rules for accounts, or also referred to as golden rules for debit and credit. That is when to debit and when to credit. So first we have to categorize our account, and after we categorize it, we have to first we'll categorize it into personal, real, nominal. Once we have categorized it, we'll define the rules and apply them accordingly. So the first rule goes like debit the receiver, credit the giver. Okay, for personal account. The second rule goes like for the real account, debit what comes in, credit what goes out. Remember what personal account is. Personal account is any person, artificial person, and the third one that we didn't ever get. So, and what a real account is, real account is anything that is related to an asset, or it that is cash or something, and purchase and sale account. The third one is nominal account, which says debit all expenses and losses, credit all income and gains. Okay, so now let me take you to an example right here. Suppose this is person A and this is person B. A has sold goods to B. So the transaction involves two person for A, and we are A, okay? We are making our balance sheet. So the transaction includes two people, that two accounts, that is first is goods account, second is a personal account. So this one is a real account and the second one is a personal account. So goods are being sold out. The real account says debit what comes in, credit what goes out. Hence we will credit goods account. And as in the case of B goes, B is a personal account, hence the personal account rule says debit the receiver, credit the giver. So B should be debit. And that is how an accounting entry goes. So if it was a balance sheet, you can see right here. So goods are represented here, goods go down and cash comes back in, hence it is balanced. This is a future concept, we'll get to it, but for now you just remember this one. Okay, so it's still confusing that what is real, personal and nominal, and now we have three things to do with them. So this is a comprehensive diagram of the golden rules of accounting. The example we took there was we sold goods, that is an asset, hence it will be classified as a real account. That was our first account, so we should be crediting our account because goods went out. Okay, and as in the case of Mr. B, Mr. B is the receiver of the goods, hence we debited Mr. B. Hence the transaction was like B debit, goods credit. Okay, we'll get to some more examples in this lecture only, so stay tight. And this here is nominal account, all expenses and losses, nominal account, all income and gains should be credited, debited. This here are some examples of what a nominal accounts are, what personal accounts are, what real accounts are. Okay, so it is highly recommended that you take a printout of that previous sheet or you make notes of that. So now we move forward. Although this sheet is not so important, but it really signifies so much and sums up so much, so that we'll study this. So this is an asset account. This is a T-shaped account right here, and this side, as I always said, is a debit side. This side is always a credit side. as you can see in every account right here. So asset account. If asset increases, okay, if asset increases, asset always comes in, then it is debit. Debit what comes in. If asset decreases, that is if we sold our asset, hence asset went out, credit. Debit what comes in and credit what goes out. Okay, and further we move to this liability account. Liability, if decreases we debit it, if increases we credit it. For example, we purchased some raw material from Mr. B, and Mr. B is our liability right now. If we have paid Mr. B, then the Mr. B liability will not be there, hence liability will be decreased, hence we will debit this. Don't worry too much, we'll be doing so many illustrations right now, so just stay tight. And this is net worth. If it decreases, it is debit. If it increases, it is credit. This is revenue. Revenue and expenses were nominal account. This was real account. So nominal account was debit all expenses and losses and credit all gains and revenues. Okay, so if a revenue, that is debit, this is, if a revenue is decreased, we'll debit it, and if a revenue is increased, we will credit it. If a expense is increased, we will debit it. If a expense is decreased, we will credit it. It's okay if you are not able to understand this sheet. If you are easily able to go to that sheet, like this one right here, this one right here, this will do the trick, and you just need to know which category of account that is. That is the first step. There are always one plus account in a transaction. So we'll see some illustrations now. Okay, so now let's move on to the second illustration right here, which says ascertain the debit and credit from the following particulars. Before moving ahead, let me tell you the step one. Step one, identify the number of accounts. Okay, and step step 2, categorize the accounts into personal, real and nominal. Step 3, apply golden rule. Okay, so as this is our first time, let's use a cheat sheet. This is our cheating sheet. It's okay. The first one here is started business with capital. So the first account right here is cash account. That is how a business started. As it is not said, you can assume it can be kind also. And the second account here is capital account. So this is our first step. We have identified the accounts. The second step said identify the categories of the account. So cash account is real account. Okay, cash account is real account, and capital account is personal account. Okay, so this is a personal account. Now we apply the golden rule. So cash comes into the business, debit what comes in, credit what goes out. Hence this should be debited, and capital account is debit the receiver, credit the giver. Hence the person who brings in cash should be credited. Suppose Mark brings cash, Mark should be credited. Okay, we are done with the first one right now. Now let's go with the second one. Bought goods for cash. Okay, so the first step, what are the accounts involved. The first one is the goods, the second one is the cash. Okay, and the second step goes identify the category of the account. So goods are the assets of the business, hence it will be considered a real account. Cash, you can see right here, is a real account as it is an asset of the business. Okay, so third, the golden rule, that's the third step. What comes in is debited. Okay. Bought goods for cash. So goods are coming in is debited and cash is paid. Hence cash is going out. What goes out is credited. Okay. So this is a transaction. Now let's check out the third one. Sold goods for cash. Okay. So the items involved are goods and cash. These are the accounts involved. Categorize these accounts. The first one is real. Cash is also a real account. Apply the golden rule. The golden rule says debit what comes in. Hence, for real account, debit what comes in. So, what is coming in? Cash is coming in right here. Hence, this should be debited. And what is going out? Our goods are going out. Hence, this should be credited. Okay. Okay, so now let's check out the fourth one. The fourth one is paid salary. So let us rewrite our steps. Step 1 was identify the accounts. Okay, accounts. Step 2 was okay. Let's do a step first. What are the accounts involved? So the first account involved is salary, and as the question is incomplete, so we can assume cash here. So the second account is cash. So let's go to step 2. Step 2 was categorize the accounts. Okay, let us categorize the accounts. Hence, the salary account is right here. It's a nominal account as it is an expense. Okay, approved. Hence, this is a nominal account. And this is cash. You can assume your bank also. Real account, cash is a real account. Hence, it is a real account. Okay, so let's check this out. Salary is paid. Salary is our expense and loss. Hence, it should be debited. Okay. And cash is paid. That is, cash goes out. So, debit what comes in, credit what goes out. Hence, this should be credited. So, the third step was step 3, apply the golden rule. Okay, so now let's move forward. And the fifth one right here is paid. Salary is done. The fifth one is received interest on investment. Okay, received interest on investment. Investment is something where they have put money in and we in expect of a return. So interest is that income. So first step, the two accounts are interest. Okay, the second account is investment. It doesn't matter which investment it is. It can be any investment. Suppose we imagine fixed deposit. Okay, so let's go to the second step. Second step says categorize the accounts. Categorize the accounts. Interest is An income. Okay. So income is a nominal account. Hence it is a nominal account right here. And investment is an asset which says it is a real account. As you can see, okay, trademarks, etc. This is covered here. So the third step goes right here. It is applicable to assets, hence that is why it is a real account. The third step is apply the golden rule. The golden rule says for the nominal account is debit all expenses and losses, credit all income and profit. Hence, this is a profit, we should credit it. The rule for real account says debit what comes in, credit what goes out. Hence, cash is coming in, I guess. So this should be cash right here. Okay, this is not liquidity, this should be cash right here. It doesn't matter, you can imagine investment also. So cash is coming in, cash is a real account, hence it is debit. Okay, as you can see right here, this is the fifth one. Cash is coming in is debit, and this is interest, that is credit. Also you can see here we named this purchase and sale as goods, but then if you want a systematic account you can never use the word good, because it is either a purchase or it is either a sale. Now let's move on to the sixth one, which says bought goods on credit from Mr. Y. Okay, so what are the two parties involved right here? First one is Mr. Y, second one is goods. Goods right here, as you can see, if you buy goods, this is a purchase. So you can name it as a purchase also, which is much more disciplined way. The second step is categorize the account. So Mr. Y is a person. He is a natural person. That's what we can guess as it is a Mr. here. So Mr. Y is a personal account, and goods or purchase is related to a real account. The third step goes personal account. So Mr. Y is the giver. Hence, Mr. Y should be debit the receiver, credit the giver. Credit Mr. Y. Also, if we go to the real account, goods came in and we made purchase. So what comes in is debited, what goes out is credited. Debit what comes in, credit what goes out, and this should be debit. Same goes for the last one, which says purchased paid rent out of personal cash. Okay. So this one is, first the account is rent, second the account is cash. Is it? No, this is not cash. It is capital, because it says right here the paid rent out of personal cash. Okay, so as you know, a business is a separate entity in the eyes of government, so you cannot pay your personal rents out of the cash of the business. Hence we will reduce the capital. Okay, so this is increase in capital, okay, not reduction in capital, because if a company has paid your cash, so the company has increased the liability that the company owes you. So the rent is a nominal account, as it is an expense right here, all expense and losses. Nominal account, capital, it is a personal account. The third step, debit, golden rule, debit all expenses and losses, credit all incomes and profit. For personal, debit the receiver, credit the giver. So we will credit this because the company has paid it. So rent account debit to capital account. Capital account is credited, hence the liability of the company is increased. Because the person has paid rent, of the office or anything that is mentioned here out of his own pocket. So the company should owe him out of that cash. Okay, so I think this is pretty heavy right now. You should take your own time and study the resources, study the golden rules, go thoroughly with it, learn them by your heart, and there's no way you can ever fail in accounting. Okay, yeah.